Thank you for joining Jennifer Strauss and Associates in our 2019 Webinar Wednesday series. We're coming to you live from downtown Washington, D.C. Our webinars are every Wednesday, and you can find the upcoming schedule on our website. Our webinars and our recording are also on our website and our YouTube channel, along with over 160 other recordings on federal contracting topics. All are complimentary. If you have questions for our speaker today, you can contact him directly to the contact information you'll see on the last slide. All right, this is just a little bit about us. We are a Washington, D.C. based firm and provide services for federal contractors. This ranges from market analysis reports to proposal writing and also post-award compliance. More information is on our website, so please visit us there. And we do have a couple of upcoming events that you can find more information on here, also on our website. And we do offer advertising, so feel free to contact this email for more information. All right, let's go ahead and get started. Our speaker today is Ryan Bradle, and he's going to be covering service-disabled veteran-owned small business contracting, understanding the requirements. Thank you for joining us today, Ryan. I'm going to go ahead and hand it over to you.
Okay, thanks very much. It's great to be here. Thank you for having me. As Mallory said, today we're going to be focusing on service-disabled veteran-owned small business contracting. And this session now will be the first in a series of three sessions that we'll have today, where we go over various aspects of being a service-disabled veteran-owned small business government contractor. This first session is focused on understanding the requirements. So what does it take to become and stay a service-disabled veteran-owned small business government contractor? And now I'm going to use the acronym SDVOSB to stand for service-disabled veteran-owned small business government contractor. So that way we can be a little more brief. Let's go ahead and bring up the next slide. All right, so this is just an overview of what we're going to cover in this session, just a very high level, the four basic requirements of being an SDVOSB, and then we'll dig down deeper into each of these. I do want to say at this point, because I'm a lawyer, to give a little disclaimer. Everything we discuss today is supposed to be sort of, general, give a general overview and provide some guidelines, but it's not specific legal advice. Every individual and every individual company situation is different. And so if there's an issue here that comes up that you think might be applicable to your company, I encourage you to call a lawyer, either myself or another lawyer that you work with, to get specific legal advice. But the purpose here is just to provide some general guidelines to help people understand what it takes to be a service-disabled veteran-owned small business. So the four high-level requirements. First of all, of course, the disability at issue must be service-connected. That's pretty obvious. The business must be small under the applicable NAICS code. I'll explain that in greater detail. The third core requirement is the business must be 51% owned by one or more service-disabled veterans. We'll go into more detail of that, but that's an important point, is that it can be multiple service-disabled veterans who can own the company, as long as together they get over the 51% threshold. And then the fourth core requirement is the business must be controlled, legally controlled, by one or more service-disabled veterans, and that means that they have the legal ability to direct the activities of the company. And of course, we'll get into that in more detail. So next slide, please. Just very briefly on the disability being service-connected. This is pretty obvious and not complicated, but I want to make sure that we cover all our bases here. So of course, service-disabled veteran, and I'll use the term SDV to refer to the service-disabled veteran. SDVOSB means the business. A service-disabled veteran, SDV, is a person who served in the active military, naval, or air service, who was discharged or released under conditions other than dishonorable. So if you're dishonorably discharged, that would disqualify you from being able to own an SDVOSB. And the disability must have been incurred or aggravated in the line of duty. So it could be anything within the line of duty. It doesn't necessarily need to be, on a combat deployment. Any sort of disability that was incurred or aggravated while performing your duty. So whether that's training or, in garrison, whatever injury might have occurred in the line of duty qualifies a veteran to be a service disabled veteran for purposes of this program. The other important point here is that there is no minimum disability rating. So a veteran, the VA gives a percentage that explains how disabled the person is due to their service-connected injury, from 0 to 100. And that percentage might be relevant for other programs. It'll dictate the sort of cash benefits the veteran might receive from the VA. But when it comes to the SDVO SB program, there is no minimum disability rating. So a service disabled veteran with a 0% disability rating is eligible to own a business that would be qualified for the SDVO SB program. So important point to know. All right, next slide. The second, key eligibility factor is that the business must be small under the applicable NAICS code. So what is a NAICS code? NAICS, N-A-I-C-S, NAICS stands for the North American Industry Classification System Code. And that is a system run by the Department of Commerce that classifies all the various industries, in North America. And there's hundreds of different classification codes, ranging from everything from agriculture, all the different types of agriculture, to manufacturing, various types of manufacturing, IT, computers, engineering, construction, all of these various high-level industries are classified down to very minute detail, or they're given a code. The SBA, the Small Business Administration, then applies a size standard to each code. And that size standard determines whether the business is small. So in certain industries, you can have revenues as high as $38.5 million a year and still be considered small. In other industries, the standards is much lower. It can be $5 or $7 million. There are industries where it's as low as $750,000 a year, but those industries really aren't relevant in government contracting. So for the most part, in government contracting, we're small businesses. We're dealing with businesses whose revenues are below a threshold that ranges from about $7 million a year to $38.5 million a year. And that's for the revenue-based size standards. Now, there's also employee-based size standards, and that's relevant mostly in the manufacturing industries. So in those industries, the size of the company is irrespective of revenue. It's determined by how many employees they have. So I've seen certain manufacturing companies that have revenues approaching $1 billion a year, but they have less than 1,500 employees, and so they're considered small for purposes of government contracting. So that's an important point to understand. How is revenue calculated? Revenue is calculated based on average annual receipts over the 3 preceding completed fiscal years. So, it can vary based on whether the company is on a calendar fiscal year or some other fiscal year. But here we are in October 2019. So if you're a calendar-based fiscal year, your last completed fiscal year would have been the end of 2018. And so you will look at your revenues from 2016, 2017, and 2018 and average those. Now, I need to caution that this requirement is going to change very soon. Congress last year passed a law that changed it to the preceding 5 completed fiscal years. And by doing that, Congress believed that it was going to help more companies be eligible to be small businesses, because if you expand it to 5 years, well, then you have some 4 and 5 years ago, you probably had less revenue. It's bringing the average down. The company's more likely to qualify. But we're waiting on SBA to institute the rule in accordance with that statute. And SBA has taken the position that until they institute the rule, that's not, then the old rule of the 3 preceding fiscal years still applies. Revenue is determined based on tax returns. Generally, tax returns are the default evidence. According to the SBA, there is no better evidence than a tax return. But in the rare situations when tax returns are not available, then SBA will look to other data, such as audited financial statements, for example. Okay, next slide. All right, this is where the first 2 requirements are pretty basic. This is where things start to get a little bit more complicated. In order to qualify as an SDVO SB, the business must be 51% unconditionally owned by a service-disabled veteran or a combination of service-disabled veterans. So a couple of sub-requirements here. First of all, the ownership must be direct. So a subsidiary company cannot be an SDVO SB. Even if the parent company is owned by a service-disabled veteran, or even if the parent company is itself an SDVO SB, a subsidiary cannot be an SDVO SB. It has to be directly owned by a person, by a natural person who is a service-disabled veteran. One small exception to this is if the company is owned by a trust, where the SDV is the grantor, trustee, and current beneficiary. So the SBA has recognized that sometimes people need to undertake estate planning activities, and it might be advantageous for their estate planning to put the company into a trust, and that's allowed. But otherwise, ownership must be direct. And then the other major requirement here is that the ownership must be unconditional. That means that there can be no restrictions on the ability of the service-disabled veteran to dispose of his or her shares. It's pretty common, especially with small businesses, that especially when there's outside investors in the business, that there be restrictions on what the owner of the company can do with his or her shares. For example, that would be a right of first refusal. If the owner wants to sell his or her shares, then they have to give a right of first refusal to the minority shareholders. But that is not allowed for a service-disabled veteran-owned small business. The rule is that the service-disabled veteran has to be free to do whatever he or she wants with his or her shares. So I've outlined a couple of examples of common restrictions which are not allowed. All right, next slide, please. There is one exception to this, and it's a relatively new exception. The rules were changed. We're going to go into that a little bit later. But the one exception to the unconditional ownership is that the service-disabled veteran will retain its status as an SDVO SB following the death of the service-disabled veteran, if and only if the service-disabled veteran's surviving spouse acquires the ownership interest in the business, and the service-disabled veteran had a 100% disability rating or died as a result of the service-connected disability. So this is a pretty narrow exception, but the rules do provide for the surviving spouse to inherit the company from the service-disabled veteran if the service-disabled veteran dies. And so that the surviving spouse has that means to support the income that comes from the company. But that only lasts for 10 years or until the surviving spouse sells his or her ownership interest, or until he or she remarries. So that's the one narrow exception. All right, next slide. This fourth core requirement is that the business must be controlled by one or more service-disabled veterans. So ownership is one thing. That's dealing with, who holds the stock of the company, or if it's an LLC, who holds the membership interest. This deals with who controls the company, who has the legal right to direct the company's activities. And the rule is that the management and daily business operations of the company must be controlled by one or more service-disabled veterans, which means that both the long-term decision-making as well as the day-to-day management and administration of the business operations must be conducted by one or more service-disabled veterans. So that's kind of a mouthful, but let's break that down. The rule goes into some detail about what exactly that means. And what the legal documents have to look like. The first point is that the service-disabled veteran must hold the highest officer position. So it has to be the CEO or the president of the company. A lot of times companies have one person is the CEO and the other person is the president. That can get you into trouble. I've dealt with cases where the SBA looked at it and they couldn't clearly tell that the president, who is not a service-disabled veteran, and the CEO, who was a service-disabled veteran, they couldn't tell who had control of the company, and so they disqualified the company. So it's very important that you clearly define the roles of your officers, if you have somebody who's not a service-disabled veteran who's an officer of the company. Going down the requirements of what control looks like, what are the legal requirements for control? The service-disabled veteran has to control the board of directors or be a managing member if it's an LLC. And the service-disabled veteran must hold enough shares of a corporation to overcome any supermajority voting requirements. So a lot of times corporations will say that will require a supermajority to undertake certain actions. The veteran has to be able to vote just the veteran has to be able to do whichever of those actions are required. And then finally, the service-disabled veteran has to actually participate in the operations of the company. So, we'll go into that in more detail. Next slide, please. One important point is that, it doesn't matter if the service-disabled veteran is able, holds 100% of the shares and so therefore can fire the board of directors anytime he or she wants. That's not enough. The service-disabled veteran has to actually control the board of directors. That's the point here. Next slide. There are a couple of exceptions, though, to the requirement of legal control, and I want to talk about those. And the purpose behind these exceptions is to allow minority investment in the company. And a lot of times minority investors will not invest in the company unless they have certain protections. And those are adding a new equity stakeholder, dissolution of the company, sale of the company, merger of the company, and the company declaring bankruptcy. Those are the 5 enumerated exceptions where the supermajority requirement does not apply. All right, next slide. Just going over some more elements of control, and the SBA has recently revised these rules to go into more detail about what control looks like, and just want to go over these really quickly to highlight the possibilities of what the SBA might look like if it believes that a service-disabled veteran does not control the company. And so there is a rebuttable presumption that a non-service disabled veteran has the power to control the company in any of the following circumstances. So if the non-SDV is involved in management of the company and was a former employer of the service-disabled veteran. So a lot of times what will happen is companies, they'll have a service-disabled veteran who is an employee. They want that person to spin off and go start an SDVO company. If the former employer is involved in the management of the SDVO SBA views that as not as the service-disabled veteran not having control of the company. If the service-disabled veteran is not the highest paid employee in the company, that can indicate to SBA that the service-able veteran does not control the company. If the company is co-located or shares significant resources with another firm in the same line of business, that can be indicative of a lack of control. Next slide, please. If there's a person who's not a service-disabled veteran that has an equity interest in the company and provides critical financial or bonding support, if there's a critical license, for example, an architectural engineering firm requires certain licenses. If that license is held by somebody who's not a service-disabled veteran, that can be indicative of a lack of control. And then finally, if there are a lot of business relationships that exist with non-service-disabled veterans, where the SBA believes that the service-disabled veteran-owned company is overly reliant on those, that can be indicative of a lack of control. Next slide. And then just the last point is that there's further indicia that the business is controlled by the service-disabled veteran, and that speaks to the service-disabled veteran's participation in the company. So the service-disabled veteran has to devote full time to running the business. The service-disabled veteran has to be located within a reasonable commute of the company's principal office or job site locations. And the service-disabled veteran has to work for the business during normal business hours. If any of these elements is not present, if the service-disabled veteran cannot fulfill one of these, then there's a presumption that he or she does not control the company. Next slide. So that's it for understanding the requirements. We covered a lot of ground there, and the point is just to sort of highlight some of the things that you should be aware of, so you can spot issues and raise any red flags if these are any issues with your company as a potential service-disabled veteran. But I welcome any questions by email or telephone. If there's anything that I went over today that you'd like to discuss further, I'd be happy to speak with you. And that's it for me.
Thank you so much, Ryan, for sharing your knowledge and insight today. Today's presentation has been recorded and can be found on our website or YouTube channel within about 48 hours. And like Ryan said, if you have questions about today's topic, please contact him directly with the phone number or email shown on your screen. Thank you, everybody. This concludes the webinar.